Hello, this video is to provide an overview of the course to supplement the information already provided. The course covers in depth the unified estate and gift tax rules relating to federal taxes imposed on the gratuitous shifting of interest in property by death to survivors. And when we say gratuitous, we're referring to something given with no obligation. And we also will cover number 2, gifts during one's lifetime, as well as the calculation of the applicable federal estate tax, gift tax, and generation skipping transfer taxes. And finally, we'll have an opportunity to prepare actual federal estate gift tax returns as well as a gift tax return. So what is an estate tax? IRS refers to this tax as a tax on the right to transfer property at your death. So in your lifetime, you're paying taxes on your income, such as the income that you earn and passive income, other types of income as well. Then at death, the estate tax that is imposed relates to what the IRS calls the right to transfer the value of your estate. And basically, if that value exceeds the gross assets over a set dollar amount that's established by the code, your assets may be subject to taxation. The second area that we're going to cover in this course will be the gift taxes. And a gift is defined as any transfer to an individual, either directly or indirectly, where there's full consideration measured in money or money's worth, and it's given for nothing in return. Thus, it's as you normally see it. If someone gives you a gift, you're not expecting to have to repay that gift. You don't have to perform any services, there's no money to be returned, and it's not a loan. Gift taxes are generally the responsibility of the donor, and that causes some confusion for many people. I find that I have clients, they'll come to my office and they're concerned because they've received this large sum of money in the form of a gift, or they've inherited money and they believe that they have some large taxes that they're going to have to pay. And I explain to them that this transfer of the money in the form of gift to them is the responsibility of the donor. It's not the responsibility of the recipient of the gift. We're also going to go through the calculations that will be covered later in the course, but I just wanted you to be clear that it's the donor's responsibility for those gift taxes. But for now, know that when a taxable gift is in the form of cash, real estate, stocks, or other tangible or intangible property, when it's made, the tax is usually going to be imposed on that donor, as I mentioned, unless there is a retention of an interest, which is going to cause a delay in that being treated as a gift. Also, many folks gift to reduce the value of their gross estate. That's an estate tax planning tool. You'll find that we're not going to cover a lot of planning issues in this course. If we do, it's just basically to give you an idea of how you might be able to use something very basically as a planning tool for a client, but this course is not geared towards tax planning in this area. The third area we're going to cover is going to be the generation skipping transfer tax. And the purpose of the generation skipping transfer tax is for the government to collect transfer tax at every generation. IRS basically doesn't want to see the avoidance of tax by having the transfer skip a generation, which makes it difficult to trace, and sometimes it gets lost out there and they're not able to collect on that tax. What occurs is if it skips the donor and say goes to the grandchild, they're basically not giving it to that child. And IRS's goal is to collect that money as early and as quickly as possible, if possible. And to make sure that there's, again, no avoidance of tax by skipping a generation and allowing that transfer of wealth to go untaxed. So this all stems from Congress deciding that if a parent elected to skip a generation by leaving property to the grandchild or even to great-grandchildren, the government would be denied tax revenue that they would have otherwise received from the children. Consequently, the GST is imposed on the transfer to the grandchild as though the transfer were made to the child. And so in effect, the transfer results in taxes occurring twice. The generation skipping transfer tax applies to outright gifts and transfers in trusts to or for the benefit also of unrelated persons who are more than 37.5 years younger than the donor, or related person that is more than one generation younger than that donor, such as we've discussed, the grandchildren. The generation skipping tax will be imposed only if the transfer avoids incurring a gift or estate tax at each generation level. For example, regarding property that's placed in a trust for the donor's child and grandchild, that income may be distributed among the child and the grandchild in accordance with their needs, and the principal of the trust will be distributed outright to the grandchildren following the child's death. So if the trust property is not subject, in that case, to estate tax at the child's death, a generation skipping tax will be imposed at that child's death. Another way to say this is when a large sum of money is put into a trust, and when that money is for the benefit of both the child and the grandchild, if at the date of the child's death they are not subject to estate taxes, that generation skipping transfer tax may kick in to cause the child to be subject to taxes at the child's death, as opposed to waiting until the death of the grandchild, which is the next generation down. Obviously, the generation skipping transfer tax is more complex than what we're covering in this overview, and we will be going into that in a lot more detail later in the course. Finally, in this course, you're going to have an opportunity, as we mentioned, to prepare a federal estate tax return and a gift tax return. And that's going to enable you to take that knowledge that you gain and apply it. So once again, I am looking forward to an engaging 16 weeks together, and that is it for this video.